Good day, everyone. My name is Carden Madzokere. I'm the author and publisher of the distinction-bound student textbooks, Economics Grade 10 to 12, Business Studies Grade 10 to 12. These books come in complete version and no answers version. Okay, in this lesson or in this video, I'm just going to explain GDP, but the income method, because the previous video I made, it was the production method. I'll recap quickly. Okay, so we started by the definition. We said GDP is the gross domestic product, which is the total market value of all final goods and services produced within the borders of a country over a specific period of time, usually over a year, right? That's clear. Now, I said some things about the definition. Number one, that it's a market value, not basic value. Market value, total market value of all final goods and services produced within the borders. I noticed that in the previous lesson, I did not explain within the borders of a country. Now, that then means gross domestic, because if it wasn't within the borders, it can be gross national income or gross national product. So if it's national, it is production by citizens of a country. Now, this one is production within the borders, regardless of who produced. So foreigners living in South Africa, foreign businesses in South Africa, they produce whatever it is that they produce within the borders. That is included on South Africa's GDP. But whatever it is that they produce, which is produced outside South Africa, even if it's produced by South Africans, it's excluded on South Africa's GDP, but included on South Africa's gross national product. Okay. Now, how do we calculate GDP using the income method? Like we know, we have the production method, the income method, and the expenditure method. So with the income method, we say compensation of employees, which means gross salaries and wages. So here we want to calculate basically the income, the gross income earned by not by citizens, earned by factors of production within the borders of a country. So we have number one, compensation of employees, which is net salaries and wages. So we take that, we add it to net operating surplus, which is profit. We then add it to consumption of fixed capital, which means depreciation. And then we then get what we call GDP at factor cost. Now, when we have GDP at factor cost, we want to have the market price at the end, just like we did with the production method, which was primary plus secondary plus tertiary equal to GDP at basic prices plus taxes on products minus subsidies on products equal to GDP at market prices. So we want to get to GDP at market prices just like we did in the previous lesson. So compensation of employees, which means gross salaries and wages, plus net operating surplus, which means profit, plus consumption of fixed capital, which means depreciation, it gives us GDP at factor cost. Now, how do we move from there? First, we add other taxes on production. Remember, just now I said taxes on products. I'm not referring to that. Here I'm talking about something like employment tax. An example would be pay as you earn. Okay, any tax that is charged in the process of employment, personal income tax. That's an example of other taxes on production. Take note, I'm saying production, I'm not saying product. Then we subtract other subsidies on production. An example of subsidies on production would be an employment subsidy. Now, what is an employment subsidy? Well, let's say government wants a certain group of people to be employed for whatever reason, whatever it is that they want to achieve in the economy. Let's assume that government wants the youth. That's a good example, the youth to be employed, and companies are reluctant in employing the youth because they lack experience. So if I go looking for a job as a teacher, together with someone who graduated last year who wants the same job that I want, because of my experience, companies tend to hire me over the new graduate. So if government wants the new graduates to be employed, they will offer a subsidy for the employment of that particular group of people. So let's say they can say any company that employs anyone between the ages of this and that, we are going to pay, let's say, 10% of the salary on behalf of the company. What it means then is, instead of the company hiring me and paying me 30,000, the company can hire the new graduate and pay the person 27,000, and then the 3,000 comes from the government if it's 10%. If government says we'll pay, we are subsidizing 20% for every person employed between the ages of this and that from this day to this day. I'm just giving an example, right? Then that company, instead of paying me 30,000, they would hire the person and pay them 24,000. Government pays the other 6,000. So companies begin to employ the youth, even though they lack experience. But in this case, what's actually making them employ the youth is the fact that there is a subsidy on production attached to employing that particular demographic. So if that makes sense, we can move on. So we said GDP at factor cost plus other taxes on production minus other subsidies on production, what I was just explaining, it gives us GDP at basic prices. The minute you get to basic prices, you already know how to get to market prices, just like we did in the previous video. We add taxes on products. I said an example would be VAT, sin tax, excise, which is excise duty. Another example can be fuel levy. All those are taxes on products, and it's different from taxes on production. Then we subtract subsidies on products. What we have left there would be GDP at market prices. Thank you so much. Subscribe to my YouTube channel and continue following me on TikTok. Like the video, share with someone that you know might need it. Thank you. God bless.